The Placing You First podcast begins in less than 20 seconds.
Visit crcgroup.com to subscribe, download our award-winning tools and intel articles that help you stay aware of emerging issues and trends, or get a snapshot of the insurance marketplace with our industry-leading Ready indexes. You'll find it all on crcgroup.com under Tools and Intel.
Welcome to the Placing You First podcast, where we explore the issues and trends shaping insurance. I'm your host, Amanda Knight, joined by my co-host, Scott Gordon. And today we've got a great episode lined up.
That's right, Amanda. Today we're diving into a topic that touches, nearly every corner of the financial world. The shift from traditional wet signatures, as they're called, to digital and e-signatures. What risks does that introduce, and how can clients protect themselves against these risks?
Well, and as more financial institutions move operations online, we're all seeing tremendous benefits, right? Speed, convenience, accessibility, but that also creates exposures and underwriting considerations that we have to think about. So to help us unpack all of that, we're joined by Mark Waldeck, professional lines broker with CRC Chicago.
This is the Placing You First podcast from CRC Group.
This podcast features news and insights from a vast knowledge base of more than 5,500 associates who write more than $30 billion in premium annually.
Plus, we give you the latest information on what's happening at CRC.
This is the Placing You First podcast.
And now the hosts of the podcast, Amanda Knight and Scott Gordon.
Mark, welcome back to the show.
No, thanks for having me. And this is obviously top of mind, a big item for a lot of our clients.
Absolutely. But, I can't say that when you hear the word e-signature, you're like, yes, let's talk about that. So I dug up a little trivia, right? A little bit of bits and pieces to get us going this morning. Did you know, and maybe you did, Mark, because you know a lot about this, did you know that the very first e-signature actually dates back to 1869? How, you ask? British courts ruled that a telegram could serve as a legally binding agreement. So basically the Victorian version of DocuSign. 1896. Who knew? Take that to your next cocktail hour. When do you think, Mark and Scott, is the most popular time of day for people to e-sign documents? Because there is indeed a most popular time of day, according to data.
I'd probably go I'd go first thing in the morning, but who knows?
Yes, I wake up and immediately think e-signatures. No, actually, according to DocuSign's data, the most common time people sign digital documents is around 3 p.m. local time, right after lunch. Caffeine kicks in, inboxes get cleared. So, if you want to rebel, everyone, don't sign anything at 3 p.m. Pick another time of day. All right, last one. How many trees do digital signatures save?
All of them.
All the trees. Going digital saves an estimated 2.5 billion sheets of paper a year globally. That's about 270,000 trees saved annually thanks to e-signatures. So now that we're all a little bit smarter, onto the serious stuff. Mark, you've been in this game a long time and you've seen firsthand how banking and financial services have evolved over the years. Can you walk us through how we went from signature cards all the way now to digital verification?
Yeah, it's a strange transition because some banks have 100% embraced this, others have not. So it really is the Wild West. And I'd say the history behind it is that push for greater convenience, faster transactions makes perfect sense. Save the environment. There's a million reasons why you should do it, but it comes with risk that I believe everyone is overlooked. And the risk is, do we make it somehow easier for the bad actors to either impersonate the real individuals that are trying to affect a transaction? And then what controls, if any, has the bank considered that should be inserted to prevent the bad actors from seizing control? So I think that's really the big, elephant in the room that we have to figure out, because digital signatures are here to stay. They're not going away. They're only going to get bigger, and it's widespread use. So now the function is, how do we make sure the insurance contracts can keep pace, because they're always playing catch up? And then how do we also make sure that the controls and procedures are also revised, again, to reflect this new environment?
Well, and you mentioned how big of an industry this is from a market standpoint. It's huge. The digital signature market is currently valued at over $12 billion as of 2025 and is growing at an annual rate of about 26.5%. That's massive.
And I think part of the problem is the competition, that if a credit union or a non-sanctioned lender makes these closings easier, let's use a real estate closing, well then banks have to keep up or they're going to lose that business. And that's the problem, is you have the sales side, which is pushing for this, but behind the scenes you have the audit side or the control side that is probably resisting.
It occurred to me, Amanda, when we were talking about the amount of trees saved, it's not just the page that the signature's on, it's all those documents that come before it. That's just page after page after page. So I can see why it's gone away. I use digital signatures every day, but some people still feel a little uneasy, Mark, about doing something as important as, say, signing for a loan document online or something. Some say that digital is safer, while others are not convinced. So how do you see the trade-off between traditional security and modern convenience?
I'm okay with our banks embracing it, provided they have the infrastructure backing it up. And what I found within my own book of business is the majority of the banks I interact with, they have decentralized controls, which runs counter to their organization. Normally the way banks are set up, because they're so highly regulated, you have to be licensed to open your doors. So if they don't follow certain safety and soundness procedures and practices, regulators can shut them down. They haven't really looked in this area yet because we haven't had a lot of claims, and we'll get to that later. But I believe the challenge is getting the banks to embrace a centralized approach to, okay, if we're going to accept electronic signatures in a remote environment, this is how we're going to do it, and we're going to do it the same way across all the silos or divisions within the bank. And what I'm finding is the lending area has their own set of rules. The trust area has a completely different set of rules, etc. That's the problem. There's no consistency even within the bank on how do we address it. And there's no regulatory guidance. The regulators haven't weighed in at all, which is frustrating. But they're usually slow to react, much like the insurance industry. We need a lot of losses or claims, I think, to spur them to act.
Well, and even at a more basic level, even, from the consumer or the insured standpoint, there's a lot of confusion about e-signatures versus digital signatures. Can you clarify? Because I would assume that those are the same thing, but they're not. So what is the difference between an e-signature and a digital signature?
I can address that if you want. It's the encryption behind it, the protection. So what you want to make certain is that there's some type of encryption software that wraps around the document itself. So that acts similar to a moat or a barrier to keep the bad guys away. If you don't have that barrier, you make it very easy then for them to see what you're signing. It makes it easy for someone who wants to reproduce your signature. All those things become very simple and easy for the hacker.
So even though both of these are legally recognized, the level of security really depends on the platform and the process.
Correct. And that's why, again, it's really the Wild West. Every time I go into a bank, I get a different response and answer from one bank to the next. And then even I was with a bank in Colorado maybe a few months ago, and I'm sitting in a room with their head of commercial lending, the head of their trust area, their head of IT, the CFO, and the CEO. And I said, what's your current stance on accepting digital signatures, if at all? And the CEO piped up right away, and she said, we don't ever do it. We wouldn't consider it. And the guy to her right said, well, that's not entirely accurate. And I could just see the whole room was about to explode. She's like, what do you mean we're doing this? But that's a great example where some cases the bank doesn't even know what the other departments are doing. So when I left that meeting, she said, we're not doing this anymore. And if we are, I want a written agreement that everybody in the bank signs on to, not just lending. It could be any department. And I thought that was really eye-opening for me because it highlights the fact that the different silos don't talk to each other. And if we have a problem, it's going to be the same problem over and over again within the same bank. He hacked us in the lending area. He hacked us in treasury risk management. He hacked us in the trust department. It just goes on and on. So I think the fear is for me to prove our loss with the carrier, having that consistency will go a long way in our ability to trigger coverage. If we lack that, we make it much easier, I think, for the underwriters and the claims adjusters to push it back and say, well, you didn't even try and prevent the loss.
Speaking of triggering coverage, I actually saw this in the news recently, Mark. An Indiana bank, I believe it was, recently sued its insurer after falling victim to a fraud scheme involving someone impersonating an NFL player. Scott, did you see that?
This is a true story. The bank, First Farmers Bank and Trust, they made a multi-million-dollar loan to someone claiming to be Njoku, assuming that's how you pronounce his name. The whole deal was done remotely over Zoom, and documents were uploaded digitally. Everything looked legitimate, and the notary even verified the ID in person, but it turned out to be a complete identity theft scam.
And the dispute with the carrier is you needed to have the original documents in the bank's possession before you would close and release the funds. And the bank's defense, and it's going to be litigated for a long time, but the bank's defense was we went out of our way to hire an independent notary as our representative to go to the remote location, sit with the borrower, in this case the fraudster, who was pretending to be the NFL player. So as far as I can see, it appears that the bank did everything they could in their power. So the only thing they probably lacked was physical possession of the signature, but I would argue the notary did possess it. And if that individual was your designee, you can see where I'm taking it. The notary is no different than a bank employee. That guy's just an independent contractor. So I think this is going to go many rounds in the court system to try and unravel it. And what I'm telling all my banks is this is an example of a $3+ billion asset bank, publicly traded. They tried to do the right thing. And sending a notary to a remote location is going above and beyond. And yet here we are with coverage being denied. And the big issue in the denial is you did not physically possess those signatures at time of closing and remittance. And I think we have to sort of pay attention to what's going on because the carriers are dealing with a policy form that was written in the 1950s. And they're not sure, in my opinion, the adjuster can only go with what's inside the boundaries of that margin of the policy. And they can't, everything is silent. They can't find anything that fits perfectly into this scenario. And when they set up some of these requirements, it started with the physical signature cards, the physical authentication. We're not remotely authenticating you. You have to be in the bank. So what I'm cautioning all my banks is let's not wait for the other shoe to drop and the lawyers get involved. Let's have the right controls up front. And then what I'm encouraging my banks to do is let me upload a copy with their permission of your procedures, not only to the regulators, to your audit team within the bank and to the underwriter. That way everyone's got it. We've all agreed up front. There shouldn't be anything to argue over should there ever be a claim. Because I don't have confidence that we can rely on our individual underwriters to sort through this. They're learning as we go.
So this is where the underwriting comes in, figuring out how to adapt the coverage to reflect how business is actually done today, right, Mark?
And we have endorsements. Some of our underwriters will issue an endorsement for electronic securities or e-signatures, but there's usually a sublimit. There may be a callback requirement. You can accept this, but you need to have a customer agreement in file prior to any of these real estate closings in this example. And you need to call the prearranged, pre-agreed number that's in that file. So there's a million trapdoors, in my opinion, as you travel down that path. All of them end poorly for the bank unless they follow it to a T. So that's why I'm pushing the controls so hard. If we can't demonstrate our controls, we're going to have a hard time proving our loss. So I think it's going to start with, how do we authenticate? What customer agreement is in file that allows a remote transaction or an electronic signature? And then if we are in this remote environment, how do we authenticate? It all needs to be, I hate to say it, codified up front, because if we don't, now we're fighting with the carrier and the adjuster, and I think we're going to have a lot of angry clients, because no two frauds are the same. But I think the biggest challenge will be getting the underwriter to sign on to the controls that I will upload to them. Hey, if you have a problem with our controls, speak now. And if you're quiet, then I'm going to take that as acceptance that this is okay, and we're not going to have a problem should this scenario present.
Well, and I love when you refer to them as your banks, because only kings, CEOs, and Mark Waldeck can refer to them legally as his banks. I love it. So, for other listeners who work with financial clients, Mark, what are some top security measures you recommend to reduce e-signature risk?
I think the regular employee training is critical. We definitely want to, carefully screen whoever those key third-party vendors are that we're relying on, because that is a whole nother area of risk. We don't control those third parties. I think having that sensitive data encrypted is really, really important, and that's both at rest and in transit. We talked about multi-factor authentication and having sort of that pre-agreed customer agreement in file. I'm trying to think if there's any other ones. We talked about the callbacks, some type of password verification. What I find, though, is the bigger the loan, the less stringent the bank's requirements are. So
that feels
if you want to borrow $100,000, yeah, it's a lot of work and they make you jump through hoops. But if you want to borrow $5 to $10 million, they're lining up to hand you the keys to the vault. And I don't know why, but that's just human nature.
Well, that's all great advice. And a reminder, I think, that customer experience and security, they can coexist. We're not trying to make anybody's life harder, but banks really do have a responsibility to balance both if we're going to build trust and loyalty at the same time. So, all right, Mark, the hard part's behind you. We've come to the best part. Before we let you go, we always like to end with a little fun. Are you up for a few rapid fire questions?
Sure.
Okay. All right. The holidays are quickly approaching, or maybe they've passed by the time our listeners are digging into this episode. But what is your favorite holiday and why?
I'm probably going to go with Thanksgiving, not just because it's nearby on the calendar, but it's easy. There's no pressure.
Yes.
All you got to do is show up and eat. You don't have to get any gifts.
That's right.
Well, I'm coming over to your house because there's a lot of pressure over here. I'll tell you that.
No, I agree. You just get to eat good food with people you love /like or tolerate, depending on your scenario. And no gifts, no pressure, just wear your stretchy pants.
So, Scott, what would be your holiday if it's not Thanksgiving?
For an atheist, I really enjoy Christmas and always have. So yeah, probably Christmas because I really like wrapping. My grandmother used to teach me how to wrap presents, so it's like my connection with her. And plus, everyone wants me to wrap their presents, so I feel useful. So
I mean, can you wrap mine? Because you can always tell when I wrap the presents because it looks like a toddler did it. I don't know. You'd think it's not that hard, but
that's my wife. And my grandmother worked at Pizit's department store in the gift wrap department back when they had such a thing. So,
so she was a pro.
Yeah.
Mm-hmm.
All right, Mark, next question. What's one thing you always keep in your briefcase, backpack, or desk drawer?
Never leave home without it.
This is going to sound weird, but I always bring Airborne. I keep a tube of Airborne, the fizzies, in all of the above. So if I'm on a plane and somebody's hacking on me, I just pound one of those and I'm fine. Not that I'm a germ freak, but I don't have time. So I'm running too fast. So I just pop that stuff. When I was overseas a couple of weeks ago, I went to a pharmacy in France and asked in my broken French, I'm looking for an Airborne. I showed him the tube. I said, it's a fizzy. It goes in water. He sells me, it's like a vitamin C chewable, but it's all in French. I drop it in a glass of water. It just sits there. It doesn't dissolve. And I'm thinking, okay, he sold me the kind you got the chewables. So,
well, that's one way to figure it
but
out.
I swear by that.
You got to have that effervescence, man.
Yeah.
And they taste good. Sorry, I'm not doing an ad for Airborne, but they're actually pleasant for what it is.
Yeah. And they do work. I mean, I feel like they are helpful in preventing getting whatever funk is trapped with you on there.
Right. Doesn't hurt you.
Yeah. Okay. And most important question, we've all established we're food people. What is your go-to Chicago deep dish spot? If you're in Chicago, where are you going?
That's a really good one. We have a lot of good deep dish pizza places. I'd go Giordano's. They're sort of the original, and it's one slice will put you to sleep. You can't eat more than one slice. It's too thick.
Yeah,
it's good.
It's really good though. It's worth every calorie.
Well, Mark, thanks for joining us again and sharing your insights on digital and e-signature risks. It's pretty clear that this is an area with both opportunity and exposure, and the right guidance makes all the difference.
No, thanks for having me. And I think there's a lot we can do here at CRC to help our clients and prospects. And I think, unlike a lot of wholesalers, placement is just one slice of this discussion. And I think it's all the other stuff that really makes all the difference if a claim comes in.
Absolutely. For more insights, visit crcgroup.com. You've been listening to the Placing You First podcast. Be sure to follow and subscribe wherever you get your podcasts, and we'll see you next time.
Are you ready to move faster and go further? Take your career to the next level. Join Team CRC to gain access to best-in-class tools, data, exclusive programs, and more. Send your resume to resumes@crcgroup.com and read testimonials from recent hires on LinkedIn.
Search for CRC Group.